Okay, well, we just got some breaking news on Canada's economy, retail sales. Now, keep in mind, we were looking for the April numbers, but also an early update on what might be happening in the May numbers, because that's the way it works. The StatsCan team gives us preliminary numbers for the data they're crunching right now. And we saw a 0.3% gain in April. Bay Street was looking for a month-over-month increase of 0.4%. But we got this advanced estimate for May suggesting that retail sales plunged in the month. 1.1%, which would be the biggest decline in a year. Now, the volatility in auto purchases seems to have played a significant role in the weakness in those retail sales, with car sales driving gains in some provinces and then leading to decreases in others. Keep in mind, when we had first gotten a preliminary number for the April, not to confuse this, but you go back to the last time we had retail sales data, the takeaway was maybe people have been buying cars or were buying cars before the threat of tariffs. So that was a lift in April. Now we've got this May number that showed that overall the receipts for retailers plunged 1.1%. So that is the biggest decline in a year. Again, that April number, which we already got an early look at that, was supposed to be up about 0.5%. Again, Bay Street was looking for the April number to be up 0.4%, ended up coming in at 0.3% higher. And with cars and parts making up a quarter of Canadian retail sales, that's quite a stark difference in sales between the 2 months, and it suggests volatility in auto purchases played a role in the weakness overall. Now, I guess the bigger question is whether or not the Canadian economy is going to stall or contract in the second quarter. Domestic consumption already weak, and consumers likely to continue curbing their spending just because we've got this uncertainty on the jobs front as well. So as we watch the loony reaction right now, let's also bring in a longtime economist on Bay Street, Sal Guatieri. He's director and senior economist at BMO Capital Markets. Also still with us, Brianne Gardner. Sal, what'd you think?
A little weaker than expected, a little weaker than Stats Canada's early estimate as well for April. But as you mentioned, what's really happening here is that people were racing to buy cars ahead of the tariffs, not just in April, but in March as well. So that tended to boost sales. Now, if you strip out sales from the April number, they were down. So it does suggest there's some underlying weakness in the measure. And then, according to the flash report, sales were down once again, led by just a payback in autos for the most part. But I presume there's some underlying softness there as well. So not overly surprising, given what we know has happened in labor markets. Employment growth has really slumped for several months now, led by outright declines in the manufacturing sector, auto industry in particular. That's driven the unemployment rate up now to 7%. So that's having a bit of an impact as well. And we know that April was the peak month of tariff and trade war concerns. And that, I think, anxiety has certainly weighed on Canadian consumer confidence, and probably went some ways to contributing to the weakness in overall sales that month. So overall, not a great start to the second quarter. And it does unfortunately fit our view that we probably will see GDP actually contract in the second quarter, more led by a downturn in exports to the U.S., weakness in business investment as well because of the trade war uncertainty. But we also are seeing consumers pulling back a little bit here as well.
Well, when I start hearing you talk about contractions, I wonder about this word recession. Just to go to your point about the trade tensions, it looks like, according to Stats Canada, 36% of retailers were affected by trade tensions in April. So obviously it's something that's been on the mind of people who are selling stuff to Canadians. For the Bank of Canada itself, which had paused its easing campaign, and I believe now we're starting to shift our focus to what happens at the end of July with rates. They're very closely watching the tariff impacts, but what do they do if they're worried about, whether or not there's sort of inflationary considerations with with tariffs, but also we've got this growing worry about weakness for the broader economy.
Well, the Bank of Canada does what it has been doing now since March, basically just moving to the sidelines. It's refrained from cutting rates further at the past two policy meetings, largely because it really doesn't have much clarity on how the counter-terrorist, number one, will lift inflation and whether that lift will be more persistent or just very temporary, but also doesn't have much insight into how the tariffs will actually hurt the economy or how much it will hurt the economy. Our general view is we could see the economy contract very mildly in the current quarter, maybe even in the third quarter as well, largely due to a pullback in exports to the U.S. But that ultimately, we believe, will push the Bank of Canada to resume cutting interest rates, likely on July 30th. And then perhaps a couple more times beyond that. So we do expect the Bank of Canada ultimately to begin worrying less about inflation and a little more about the economy. We do expect the unemployment rate, unfortunately, to drift up about a half percentage point as well. So once the Bank of Canada sees evidence of the economic weakness, probably will resume cutting interest rates.
Yeah, Sal, and just, adding on to that GDP contraction that you had mentioned, I think seeing, retail sales slowing, inflation easing, geopolitical risks rising, with all these moving parts, do you still see a soft landing for Canada? Or what are your thoughts there? I know you mentioned kind of potentially 2 negative quarters of GDP growth.
Generally, yes. We do believe that the downturn in the economy will, number one, be very shallow, very mild, and won't last very long because we have seen, at least in the past couple of months, some moves towards the trade tensions dialing back, the tariffs being rolled back as well. And that's our critical assumption, that we see continued de-escalation of this trade war. We'll find out probably within 30 days. When hopefully we have a more significant deal with the U.S. on tariffs, and that lays to rest a lot of the uncertainty about tariffs, which right now is paralyzing business investment in this country and holding people back from spending as well. So we do expect that downturn to be fairly mild. We do expect the economy to begin recovering later this year and to grow quite nicely through next year on the back of those expected further Bank of Canada rate cuts. The federal government has a lot of infrastructure spending planned, a lot of support to the affected industries, steel, autos, aluminum, affected by the tariffs. So we think ultimately that will support the economy. But again, we do have to get by this trade war first.